Hi, this is Randy Finney with the right side of the chart, and this is an early session update for Friday, May 7th, 2021. I figured this would be a good time to get a video out there. I know static charts are useful, and I'll make a point to post those when I get the time or if I see anything interesting. But I wanted to do a video to kind of convey my thoughts here and this video will be limited to the broad market, so it won't be that long. I'll just get it out, talk about the major stock indexes and the sectors of the S&P 500. All right, so the reason I'm doing the video now is here we're at the top of that bounce target zone. Again, that ranges from 336 down to 332. The other day we hit the 332, so it was an objective place to start adding into shorts. You can take a full or partial and add up to the top. But at this point in time, and this is why I want to do the video, where initially I had planned to add up to there, I'm not going to do it right now. I'm going to hold off. Now let me say this. It is still an objective area to add. That is a big gap, especially for active traders. You can game a quick pullback short here. As we know, traders love these gaps. Let's talk about that real quick. What happened? Remember this gap right here that I highlighted, the gap from April 1st to April 5th. That was a 3-day weekend, Good Friday. We hit it the other day, and I was doing the video at the time, reversed off it. Traders love these gaps, and then that's exactly, look at that, and then once you put in a reaction low, we slight move below where I had the line. This is the actual low right there, and that's pretty much what we hit yesterday. I think you can see that on the video. So the buyer stepped in. Now, whereas that was an important support level before, it's even more important. Why? Because it's had an additional validation, additional reaction. That's a reaction right there, and so that is the big level now. In fact, I'm going to leave that yellow. Yellow are the more significant levels on the chart, but we could certainly color that one up and just remember now yesterday's lows as well as that previous reaction low are the levels to watch. Okay, so what don't I like about it? Why aren't I doubling up or adding any more short exposure right now? And I may, depending on what happens later, but not right now. This would normally be an objective level, but I don't like what's going on as far as the short case goes for the S&P 500. So we're going to talk on that. Either way, like I said, your call. You want to take a shot there. You still have a trend line to back test, but the fact that we already had a rejection at the bottom of the zone and they came in so far pretty aggressively, decent volume buying up that second pullback there, and that that's bullish until unless that holds. We did get a correction. It's not as if it's not as if these negative divergences didn't play out. We had almost a 5% drop in the Qs, but that's half of what is considered a correction. A correction is considered a drop of 10% or more, at least the old school definition. So there it is, QQQ at support, gap support. If we can power much above it and close, print a solid 60-minute close above that gap, I can't spin that as anything but near-term bullish for now. And so at that point, I certainly wouldn't be adding any more shorts at that if we get solidly above there. That also potentially opens the door for a move to new highs. So let's see what happens. The day is young. This candle's still in formation now. Let's talk about the S&P 500 real quick, and then we'll wrap the video up. Okay, so the other day, I mentioned that sell signal on QQQ, which was the yellow line, again, 334 when we broke it right here. And it was a sell signal. It was certainly good for a quick trade, for an active trader, even to recycle if you wanted to buy that gap support, play the long balance, again, depending on how active you are. But as far as swing trading goes, or position trading, we never took out that level in SPY, so we didn't have the concurrent sell. We had a minor support level right there, break that 416.68 right there, but we didn't even come to a full test of my 410.39. That's the level I've been highlighting for weeks, as we need to see SPY take it out. So as I often say, you got a check mark for a short trade, a swing short on QQQ, but that check mark was invalidated because you didn't get one on SPY as far as a swing trade goes. So that's it. The S&P 500, which is more of the stock market, more representative of the economy than the tech-heavy QQQs, so far didn't even make it down to support. So we didn't get a sell signal there. That's what we would have needed. And now, look, now we're taking out, we're at new highs in the S&P. So that's the reasoning. Hope you understand why I wouldn't add at this point in time, even though we're at the top of my bounce target zone. Logic, common sense would dictate, hey, if you're going to short here at the bottom, you get even a better short entry at the top. But now we've already taken it out. So there. Okay, I'm not going to beat a dead horse. I think I've conveyed my thoughts pretty clearly on that. Is the divergence still in place? Very much so. Where I take the lines right here, it's like football. You get a first down, they move the markers, and I'm going to just move these lines right here. And now, eventually, if the SPY goes on to just burn through these divergences and we don't have any divergence anymore, meaning we've taken out these previous highs on the indicators, that's nothing but bullish. Right now, we do have divergence, so we'll just stay on alert for any reversal. And right now, that's still the number to watch, I think, 410.39 on SPY. Now, a quick run through of the sectors, and all I'm sticking with right now are 60-minute charts because we're just looking, this is really focused on swing trading. There's nothing that's changed in the long-term trend, of the S&P 500. All long-term indicators are still bullish right now. I'm going through in order of the weighting in the S&P 500. There are 11 sectors, so these are those sectors via their ETFs. And first one here is XLK. XLK is going to mirror QQQ quite a bit. There's that gap, not coincidence. You can see as I zoom in nice and tight. XLK is testing slightly above that gap as well, roughly 139.63. I'm talking about the gap right here. And the same thing, double bottom. It came in at support when QQQ hit support the other day, and it retested that yesterday, and so far pretty aggressive buying off there. So we are at resistance, and that's about that 139.63-ish level. If it takes that out, there's just not a whole lot between here and new highs. The previous highs, which so far was a double top high right there, is about 143.72, give or take. So again, if we can power on through here, we may make a run at it. And if we do, you know what usually happens? It's just the MO in this market. You put in a marginal new high. That seems to be every time the S&P 500 ekes out or the NASDAQ 100 breaks out the new highs. It doesn't rip because we're not building a basing. It hasn't built a multi-month base. Well, actually, no, take that back. Yeah, we actually have. Let's see. When we go back to not in XLK and not in QQQ, more so in some of those market leading FANG stocks. That's where we have those multi-month bases, and a couple of them have already broken out. But all right, so the levels again, XLK, big level right there. And the most probable scenario, if they can power on through this resistance, is that marginal new high, because that's so far been the MO. You take these divergences like this, you'd have negative divergences if it happens, and so that's where we might be looking to even throw out a starter short. It's tough because you don't have resistance. The exact timing on that is hard because marginal can be a fraction of percent. It could be an equal high. It could be 2, 3, 4, 5% even, as long as those divergences are intact. And then more important, here's a trend line. So if you're kind of patient, you're waiting to short the next correction, you know that things are really, kind of stretched on the indicators, overbought conditions, excessive bullish sentiment, big correction will be coming sooner or later. And that would also give you an additional check mark if you want to give it the benefit of the doubt. And during a strong, resilient trend, when dips get bought up pretty aggressively, you need to. It's I always use the analogy. It's like a case, a legal case where the defendant is innocent until proven guilty, and you have to have a preponderance of evidence, guilty beyond a reasonable shadow of a doubt. And that's kind of the same thing if you're going to short a strong trend like this. The more sectors, and that's why I'm going through these sectors that you see break down to confirm the levels I've been highlighting on the indexes as well. You need to first and foremost, like I always say, get the S&P 500 and NASDAQ 100 to both break support. That hasn't happened yet. And then when they do, what happens? Well, what happens if they break support and tech comes down here, hits support, and the buyers step in at the trend line? No, so you'd want to see that get taken out, and especially XLK, because it is the largest sector by far. 1/4 of the weighting of the S&P 500 is solely in this one sector, out of 11 sectors. And then over half of the NASDAQ 100 is tech stocks. So if nothing else, you watch XLK, and you want to see that go. And then the next up is XLV. That's the second largest sector in the S&P 500 at about a 16% weighting. I haven't updated the chart in a while, but we had divergence right here. You can see, and only a little bit here on this. When you look down on the RSI here at the bottom of the screen, you can see down there small divergence, and so that was a divergent high. Went on to break a trend line, which was your sell signal back test, and we had a decent correction from that divergent high. That was about almost a 9% drop. What's happened since then? Divergence has simply been extended, and at this point we're about almost equal there, but a slightly higher high. I'm just going to draw it this way now, and let's just take that line, leave it there, and just draw like this, a little divergent high. And again, let me show you what I'm talking about. All this, and this little divergent high shows better when you go down to a 60-minute chart when you're looking at the more near-term action. So there's the lines that I'm watching right there on XLV. And I think I've already set a price alert on this one. If not, I'll make sure I do. And then price support below it about 121. So there's 60-minute chart. See that little divergence I pointed on the daily? See how it shows much clearer here? And it's what I call potential divergence. Big difference. I have a lot of terms I make up in trading. Not confirmed divergence. Why? Because these are in momentum indicators, and right now they are pointing straight up, even the PPO right there. And so if they keep going up because the momentum is up, you take out these previous highs and you no longer have divergence. That's why it's only potential. Potential because we're still below that previous high. When will it be confirmed? I'd like to see the PPO make a bearish crossover, turn back down, and then you effectively put in lower highs, on the indicators with higher highs and prices. So, and if you get the confirmed divergence, then you look for the sell signal. First be a break of the trend line, then a break of 121, and at that point you have additional check marks to put on some swing shorts in the market, because this is again heavy weighting in the S&P 500, and if the healthcare sector corrects, it's going to have an impact on the broad market. Next up, financials. I haven't updated these weightings. From time to time I do it. These change. It could be a little bit different now. But about 11%, third largest sector. Financials are benefiting from Jerome Sunday morning Powell, I like to call him, because he's easy like Sunday morning, just keeping the pedal to the metal. That is super bullish for the banks. Increases their spread, their margins. Their whole business model is primarily, of course, they gun the market and they make money off trading desks and other things now, but for the most part they're spreads. They take in your money, pay you next to nothing, either a zero or near zero on your checking and savings and money markets, and they're turning around right now and lending that money out in car loans, house loans, boat loans, commercial lending at much higher rates, because the yield curve right now is very steep. Fed's got the short-term rates near zero, and that's what the bank's paying you, and then long-term rates are higher, and so they're lending money out here, and that's their spread. So what banks don't like is if short-term rates go up and long-term rates are going down, then they got to pay you this much on your deposits, and they turn around and they're not making that much on loans. So as long as that happens, that's good for banks. But here's the thing: the big but is that the market looks 6 to 9 months ahead, and if you wait for that to happen, it'll already be priced in. So what we use is technical analysis. You just watch these trend lines, a little trend line break. You want to, ideally, if you have divergence and you get corrections along the way, uptrend continues, trend line break. Well, yeah, we had some divergence there as well. Little correction. They've been buying up the financials pretty aggressively. Where does the next correction go to? This is a big level here, about 35, 39, but we have absolutely zero sell signals on XLF right now. We have some potential divergence. That's it. So again, these are sectors to watch. There's a trend line to watch, a potential trend line. I'm not crazy about it because you only have 1, 2, 3 reactions, but that's enough to validate it. And again, if we get another tag, great. Either way, break of the trend line likely bring us down to 35, 39. All right, we'll fly through the rest of them. Remember, as I click down this list and get to each one, it has a smaller and smaller impact on the market. There's a divergence right there forming on XLC, the communication sector. This is our old, used to be known as the telecom sector until a couple of years ago. They changed that to the communication sector. And of that, although it has about 11% weighting in the S&P 500, you really don't even have to watch this. You can just watch two stocks, Facebook and Alphabet. I haven't updated this in a little while, but it should be the same. Facebook made up last year, around the middle of the year, a whopping 21% of this sector ETF right here was attributed to the returns only from that one stock. And then Alphabet, over 20, because remember, Alphabet has two share classes. And if you add them up both, you come up with over 22%. So those two stocks alone make up 44%, or almost half of XLC. And that's why I often look at those FANG stocks. And there's your primary uptrend line. This is a daily chart. That's bigger picture stuff. But 60-minute to kind of zoom in, this is the best fit I can have right here. So that's the trend line we need to see taken out to give this sector ETF a check mark for shorting. XLY, consumer discretionary. Amazon's going to be a big one here. That's it. A little locked in a little sideways trading range. Need to see 174.25 taken out, bearish, and 180.15 taken to the upside, bullish. Should it happen anytime soon, however, put a little asterisk by that bullish, call. Because anytime soon it's going to have, it's just simply going to extend these divergences. And I'm not a big fan of taking breakouts that occur with negative divergence, because much more often than not they end up failing after just a marginal pop. Sometimes they can go on and go and burn through the divergences, but again, put the odds in your favor. Trading can be tough enough, so you want to take the cleanest looking setups and kind of just pass on those that are questionable. And as I said, Amazon, that's the big one right here. Over 21% is Amazon, and 13% Tesla. Those numbers may have changed. That was as of March 8th of this year. So I'd have to check that. And it probably didn't change too much since then, but okay. All right, we're almost done here. And then you go back to the 60-minute chart. You have industrials. Nice clean up trend line. You can see that on the daily as well. This is actually all the way back. Forget about all these other lines here. If you're going to look at one line on this chart and you're going to replicate it and set a price alert, come off the March lows. That's a major reaction low in the markets and many sectors and stocks, just about everything, commodities, you name it, and draw that uptrend line. It's a lot of reactions here. So you want to set an alert, and when that trend line breaks, that's probably going to take the financials down, or I'm sorry, industrials down to about 93.80 at minimum. And from where we're at today, that would be about a 10% drop. Now we may go up another 5, 6, 7. We could, who knows? Hard to say. And if we do, we just simply extend that trend line and we watch it. All right, but back to the 60-minute chart. That's what it looks like. And again, as long as you have the industrials above trend, the S&P 500 is probably not going to go down that far. XLP, consumer staples, we get down here. Now we're only talking about a 7-8% weighting, but still worth noting. And defensive sector, it's also going up. Right now, again, broad-based participation in the S&P 500. And let's go back to the 60. There's your trend line right there. There's your divergence. So this is basically a wedge pattern, or bearish rising wedge. Divergence needs to be confirmed, and of course you need to take out that trend line to get a sell signal. XLE, energy stocks, watch, rinse, repeat. You look for these divergences building, you get the corrections. Then you look for positive divergence like you had right here, and you get the rallies. Then you get the negative divergence, and ideally with the trend line break for your sell signal, you get the corrections. And then most recently we put in positive divergence right here. Had a best trend line I could fit is that one, breakout, back test, and then rally. And this is our current trend line. So this is what we watch at this point in time. Potential divergence forming, which says, sooner than later we'll probably come in and move down and break that trend line. But until we do, the trend is up. And if you see right here, these trends can last for quite a while. Sometimes they don't go that far. XLU utilities. I'm not going to spend a lot of time because utilities will not move the needle on the S&P 500 no matter what they do. They only make up about 3.5% of the S&P 500 as far as weightings go, so it's really not worth watching. There's a little recent divergent low after the correction right there. If I could draw it out for you, you can see that there. So you had the little divergent high at the highs right there. Little divergent high, breakdown, but then you put in divergent low, and again, the primary trend's been resilient. So sometimes these patterns or the bearish setups, they're playing out for corrections, but just not that much. You got to be pretty quick, take shallow profits again until we get those sell signals larger, more significant sell signals on the broad market that I'm talking about. Then you'll start to get some corrections that last more than 3 to 5%. XLRE, this is the real estate sector. Again, will not move the needle because we're going down on the weightings. This is only 3% of the S&P 500, and recently had a breakdown there. So it's on a sell signal. I think there's probably, looking at this one, there's probably more downside here in the REITs. You can see pretty big divergence and a pretty long and stretched trend line, and that corrections usually don't happen in one fell swoop like that. Usually at minimum you get an ABC corrective wave, a 3-wave correction. So we'll probably get another leg down. Hard to make a case where to short it, or if you want to. Remember, these are REITs. You're going to have to use, like I always talk about with bonds, you got to put a significantly larger position size because they're less volatile. They're not as risky as and high flying as tech stocks. So if you want to make money on REITs, like for example that divergent high so far, it's only dropped 3%. But you double up your position, and that effectively gives you 6%. Or the same dollar amount, I should say, as you would make on a drop on something else like that. That you have a more aggressive security like QQQ, for example, that you trade for maybe a 6% drop, but you might only put in 10,000 in a short trade. Where this one you put 20,000, get your 3%, you're still making the same $600. That's how that works. And if it goes against you, well, again, it's going to go against you less. So your stop is going to be smaller in percentage term, and it'll be equal. Everything equals out in dollar terms. I've had securities, and if you've traded on this site for a long time, many stocks have gone up and down over 100%, trades several hundred percent, and I've had some that went against us, 30, 40%, those high flyers where my profit target was, in the triple digits. But 30% loss isn't a big deal if you've taken your position size down so small that you're losing less in dollar terms than you would on a a SPY or QQQ trade that got stopped out for a 5% loss. That's what I call beta adjusted position sizing. XLB, basic materials, again, won't move the needle, but to be bearish in basic materials would be to be bearish in commodities, which obviously I'm not. So these guys are going up because this is the Powell inflation trade. Everything related to basic materials, commodities, things like that. And they're about to take out. This is an example where we've had divergence building, but if we go up much more, these previous highs are going to be taken out in the RSI and the PPO, and commodities or basic materials may continue their march. Okay, so that is it. That's all I wanted to cover. I want to share my thoughts, and just to wrap the video where we started it, that's what it would call reaction. A reaction is not always a reversal. I define a reaction as a pause, consolidation, or a reversal. Basically you have momentum. This is a uptrend, up. You hit resistance. This is what that little, when I started the video, we were a hair above there, and we came back down. That's what I call momentum field overshoot. We had tremendous momentum since this candle yesterday, last candle of the day, and it continued with a big gap up today. That's nothing more stronger as far as upside momentum than a gap. And so that carried us slightly above that 336 level on an intra-candle basis, meaning it's a 60-minute candle. So anything between that, that period is in intra-candle, and boom, right back to resistance. So that's where we're probably going to park and finalize this candle today. And then, so what you do is now you watch for the next candle. If they close it up here, bullish. If you get rejected, well, could say bearish, but at this point in time, like I said, with everything I just talked about on the S&P 500, you're going to need to see some of those sectors reverse and break down. But again, I'll maintain what I said earlier. You can certainly take a shot here at a short with a stop somewhat above. Also, an active trader might want to game a quick pullback off that level. Where to? These same levels in reverse. 336 is resistance, so 334 is now support, and then 332. Those could be two potential pullback targets. And where you put your stops will depend on which one you're going for. You're going for this one, you can put a stop somewhere up here. You're going only for this one, you want a much tighter stop, probably right above today's high, something like that. All right, let's wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.